Welcome back to Moving to Hampton Roads. My name is David Tortellini, and I am once again joined by Jeremy Jordan of Atlantic Bay Mortgage. With rising interest rates, we're all looking for ways to save money. So today we're going to talk about one way to do just that, and that's by using the adjustable rate mortgage. You've heard a lot about it in the past. It's changed. It's a little different now. And so I think there's a lot of great information. So if you may want to use this loan type, we're going to talk about it right now. If this is your first time to the channel, hit that subscribe button so you can see all of our future videos. Then when you're ready to get started, give me a call, shoot me a text, or send me an email. And if you're ready to talk about your mortgage or maybe you have some finance questions, give Jeremy a call here. He'll help you out. All right, let's get to our video. Jeremy, thanks so much for being here today.
Yeah, man, thanks a lot.
Really appreciate it. So we're going to talk about adjustable rate mortgages.
Sure.
Yeah, so I mean, when I got in the industry in 2010, those were kind of, they had a bad reputation.
Right.
Yeah. So tell me maybe a little bit about what was going on back during, with people doing adjustable rate mortgages back in 06, 07 that got them in trouble.
I mean, there were very unique financing options available at that time. Yeah. I mean, those were back in the days where, an adjustable rate mortgage, if you had heard that in the marketplace, you kind of wanted to run away from it because a lot of folks were finding themselves in a position where, they had entered into an adjustable rate mortgage in an effort to be able to better qualify for that home from a monthly payment perspective.
Sure, yeah.
Then they got in. They really didn't fully understand what an ARM was.
Yeah.
And, I'll be hard-pressed to say, I think that the mortgage consultants and those folks back then did a poor job of educating the clients on the different impacts of an adjustable rate mortgage.
Sure.
I think right now, one of the things that adjustable rate mortgages have done is it's found a very niche place in the marketplace.
Okay.
And I think with the regulation and reform, as an industry, adjustable rate mortgages for the right, clientele really makes great sense right now.
Yeah.
Some of those ARM features back in the day had what's called negative amortization.
Yeah. What's that?
What a negative am option would give you would enable somebody to not even pay the minimum interest only payment on their mortgage.
Oh.
So, in an instance where, they may have bought for $400 and, their home depreciated by, let's just say 10%.
Yeah.
They might have limped in with no money out of pocket and started at that $400,000 loan. And, next thing you know, they're not even making the minimum interest only payment on that mortgage. Now they've had a 10% drop in their home valuation. And that negative AM feature is basically adding additional, principal and interest back into the loan. So what happened was a lot of folks got in a tough spot. They got accustomed to making that minimum, negative AM payment. And then the market, corrected itself a little bit, and they were kind of stuck, but now, these ARM programs are really more of a full documentation type situation.
Okay.
There's you're basically making the principal and interest payment on the mortgage, albeit at a slightly lower rate than maybe the market rate is at the time.
Sure.
So, and again, I think from a loan officer standpoint, being able to explain the benefits of an adjustable rate mortgage, it may not be in the financial, picture for some homeowners.
Yeah.
But from time to time, I'll have, clients move to the area and tell me, hey, this is a 3 to 4 year home.
Sure, especially around here with, with military and
that's right. So in that situation, it might make sense to do like a 5-1 ARM, or we hedge a little bit and end up doing a 7-1 ARM, and which I know we'll go on a little bit later during the video. But now those interest rates are slightly lower than the marketplace. So I think again ARMs are back and they're serving their purpose for the right situation.
Right, and so people are saving what, about quarter point, half a point, something like that?
Yeah,
right
for
now?
Sure. Yeah,
which is good money.
Oh yeah,
it really is. Yeah,
especially every month for the life of the loan. Over that 4 or 5 or 7 year period, 10 year period. Whatever ARM you elect to. But again, if somebody knows that they are moving within a 3 to 5 year period,
right?
Those are the scenarios that are in place right now that folks are entering into those ARMs.
So when you do an adjustable rate mortgage and you're in an ARM, what are the time period options right now? Are they 3, 5, 7?
I mean, so really, I would say the norm is a 3-year, 5-year, 7-year, or 10-year ARM.
Oh,
right?
10-year. Okay.
Yeah, I mean, those are kind of, but I would say the norm is a 5 to 7 one ARM right now.
Yep.
But again, there's a 3-year option, a 10-year option.
And then just to clarify, when you do a 5-year or 7-year ARM, you are actually locking in that interest rate for 5 years.
That's
and
right.
then it becomes adjustable after that. So if you're in a 5-1 ARM, you're locked for 5.
Fixed rate, yep.
Yeah, they should almost call it a 5-year lock instead of a 5-year ARM.
That's right.
Because people, I think it's adjustable throughout that 5-year period.
It is not.
It is not.
Yeah,
okay.
It is a fixed program for the duration of that cycle. So if we use an example of a 5-1 ARM, for example, and we use a start rate of, let's just say, 3.5%.
Okay.
Right? And the one thing about an adjustable rate mortgage, it has caps, and what we'll use for the sake of this video is a 5.25 cap. So, a loan like that has a margin of 2.75% and an index of which is tied to the 1-year Treasury. There's also a floor of say 3.5 or 4.5%. For the first 5 years, if we have a start rate of say 3.5%, then that is a fixed rate over the course of the first 5 years.
Okay.
So it is fixed at 3.5%, and that rate won't change until month 61.
Right.
Throughout that period of time, you always have the ability that if rates were to correct themselves and go back down, you could apply to get a lower interest rate and refinance.
Okay, so you can refinance if you're in.
If you start in an ARM, you can always get out of an adjustable rate and move into a fixed rate.
Right. So if I'm at a 5.5% ARM right now and rates drop back to where they were last year,
say 4% or 3.5% or whatever the case may be, you can refinance out of that ARM and go into a fixed rate.
Well, that's a great idea.
Which a lot of folks kind of take advantage of.
Absolutely.
But going back to that 5.25 cap, the first number, the 5 represents the fixed period over that period of time. The 2 would represent the maximum adjustment in say month 61. So for example, if we go back to that start rate of 3.5%, the max even at month 61 would be an increase of 2%.
Got it.
That's the max it could go up. And then the 5 represents the lifetime cap. So if you again started at 3.5, the max it could go to is that last number, which is 5%. So the max it could increase would be 8.5%.
8.5%. Okay.
But the one thing that folks have to keep in mind, let's just say that the average interest rate's 5.5%, right? And an ARM gets it down to 5%. Mm-hmm. One of the things is that over that period of time, you're taking advantage of paying less interest over that accrual period, which in essence more money is being applied towards the principal balance by having that slightly lower interest rate.
Right.
So there are some tangible benefits of ARMs, and we're seeing consumers want to be educated on ARM options right now.
Yeah.
And if it can help them save money on their monthly payment, and they're not as much risk adverse, and they understand how an ARM works, and we've done a good job explaining that to them. And again, we always tell our clients that if you do get into adjustable rate mortgage, we're going to do an annual mortgage review with you. We're going to do the proper follow-ups, that if there is opportunity for you to refinance, we'll educate you on that and give you those tools to make an informed decision.
All right, that's great. I think that with a lot of people really trying to look to save some money right now, prices are still up, especially here in our area. I know we've seen, a little bit of a dip here and there, but not too much. And people are really still struggling with the adjustment, knowing that a year plus ago they were at 3.25.
Correct. Unprecedented.
And now we've seen this big jump. And even though from a historic perspective, it's not like interest rates are high. They're still on the lower side of average or below average.
For sure.
But, relative to what we've been used to the last 10 years, that's all that really matters to most people. So
that's right.
This opportunity to kind of save that 0.5%, it actually even could help them afford a little bit more of a house too, if they're trying to get into a little bit better home, that sort of thing.
Sure.
So what's a situation where someone should is there a situation where someone should absolutely not do an ARM?
I mean, for a first-time home buyer, right, I'm always a little bit more hesitant, to offer, more of the ARM options to more of a first-time buyer. Why? I just think it's just more added security, in a sense that whatever their fixed rate would be, if they did a 30-year traditional fixed rate, they would, be able to budget accordingly around that payment. And after, year 5, for example, if the treasury plus the margin is such that they wouldn't feel any rate increases, and affect their bottom line on their monthly payment. So, have I done ARMs for first-time buyers? Sure. Is it a smaller percentage by a great amount? Probably so, right? Yeah. These are folks that more designed from a financial perspective to maybe take on a little bit more risk. They understand the pros and cons of both of how an ARM works. And again, in those situations, they may hedge a little bit and go for a 7-1 ARM or even a 10-1 ARM.
10-1 ARM. That's
just to hedge against that potential for a rate adjustment.
Well, the 10, I mean, the average first-time home buyer is only in their house for 7 or 8 years.
Yeah, so, for sure.
Yeah, for sure. To do a 10, most won't even hit that number.
That's right.
Yeah.
The only other thing is that on some of the more traditional first-time home buyer programs through like Virginia Housing and things like that, there isn't an option for an adjustable rate mortgage.
Gotcha.
30-year fix is what we would put them in. So again, it's for more of those folks that are applying to for a down payment.
Okay. So
conventional.
So they are all basically a conventional product.
I mean, they're not. I mean, you can do some government-backed adjustable ARM programs as well. But again, we typically find that it's more of a conventional based program is the tendency.
Is there a VA adjustable?
There is a VA adjustable. Yeah, there sure is.
Okay.
And again, those situations kind of get looked at on a case by case basis, and what we'll say is, hey, this is the fixed rate. And this would be an adjustable option for you. For some of our military clients, we do find that they typically will resort to more of a fixed rate program just because there are instances that when they're getting ready to PCS and move, instead of selling, they do end up keeping their property.
Yeah, a whole lot, yeah.
And, they end up, being in more of that fixed rate, option, more from a budgetary standpoint as well. But then to be able to take advantage of more of the fixed traditional, interest rate reduction loan programs and stuff like that, which they can directly take advantage of too if they're in more of that fixed program. But again, it's we try to lay out all the options for consumers and give everybody some different options. So, but again, I think ARMs they're back. They're here. Since I've been in the mortgage business, ARMs were never really talked about. And ARMs are always talked about in more of a rising rate environment, right? Right. Because what we're trying to do is get the lowest possible interest rate. So, what we've seen is ARMs have resurfaced, heavily over the course of the past 12 months.
Right, and it makes sense. I mean,
for sure.
And they're a much more stable program than they were before. Because
agree.
It seems like a long time ago, or now 12, 13 years ago, they used to, when your fixed period was up, you could jump significantly.
Correct.
And now you can't make a 7% jump. You're not going to go from 3.5 to 10.5.
And understanding those caps and getting with the bank or mortgage company to have them educate you on what does the 525 mean. And again there's. Even on the loan disclosures that the clients will have to sign, it kind of walks them through, like, hey, what is if the worst case scenario happened and we had a full 2%, adjustment, as much of a 5% over the life of the loan, but that 2% adjustment, it actually shows them what their projected, payment would be worst case scenario.
Got it.
Because the one thing is, as the principal balance is going down, their payment's not decreasing at all because it's still whatever the start loan amount is. That's how their principal and interest payment is derived off of. But the ARM paper, the paperwork on the loan disclosures really shows them kind of what that worst case scenario would look like if it came to that point.
Right, so. Absolutely. So I mean, that's all going to be laid out in advance. No one's ever going to sign up and not have a full understanding of all this. And of course, if they have any questions throughout this process, definitely that's your job to be there to help guide them and counsel them on exactly whether or not this is the best program for them and what their long-term risk is.
And for years over the market, in 2020 and 2021, when rates shot down and the Treasury yield went down low, I mean, there were instances where a lot of folks were their payment was going down.
Well, I was going to say, yeah. So if let's say you lock in at 5.5% on a 5-year ARM,
Right.
and then at the end of that period on month 61, interest rates are 3.5%. Where does your loan go?
So there's always a floor.
Okay,
So the lender will give you, kind of a floor too.
Okay.
So they give you your maximum adjustment,
Okay.
but they also, would dictate kind of what a floor would look like.
But
So-
you could theoretically go down
But you theoretically would drop a half a
Half a
point,
point.
3/4 a point, maybe even a point,
Wow.
depending on the loan. So it's not unreasonable to think that couldn't happen as well. So we always try to talk about the worst case scenario, but the best case scenario would be that start rate actually goes down in month 61.
So there is a little bit of like people are betting a little bit if they, if people really feel solidly that they think interest rates are going to be lower, a few years down the road, but worst, you could also, if they go even lower than that, you can always just refinance.
Yeah.
And, let's say you lock in at 5.5 and they're eventually 2.5, you can just refinance.
Correct.
So it's not like you're stuck in this payment for the rest of your life.
You're not stuck. And again, I just think it's just fully understanding, how the ARM is going to work.
Yeah.
And again, understanding in month 61, what could it look like potentially, and making sure that's all kind of laid out.
Right. Yeah. And it's good if people understand what their financial future looks like 5 years from now. There's a big difference between someone who's, 25 years old and at 30 years old should be moving up in the workforce and hopefully making more money, versus somebody who's nearing retirement and may soon be on just their pension or Social Security.
Sure.
So you have to have a full understanding of what your finances may look like 5 years down the road.
Yeah. And for some, like some clients will get into an ARM at, say a 7-1 ARM, for example, or 10-1 ARM even, and they know that they want to just hammer away at paying down their mortgage.
Right.
So some of them will use it as kind of a savings tool to capitalize on a slightly lower interest rate, but also have that forced forward thinking to say, hey, as a bonus comes in, or whatever the case may be, commission, over and above what my normal pay looks like, we're going to, or a tax return, we're going to roll that money directly to paying down that balance.
Got it.
And some of them, some folks use it that way as well. Yeah. So, I have a financial advisor out of Williamsburg that has recommended over the course of the past year that all of their clients, look to utilize adjustable rate mortgages, because of the belief that, we're at a kind of a ceiling from a rate perspective, and there's going to be opportunity in the near future to, benefit from, a potential refinance. Mm-hmm. I'm always, hesitant to guarantee that, right?
A little bit more conservative. That, right? You don't know what the future holds, black swan events. And all
while the analytics might point to rates coming back down, later this year, I think that's pretty, a well-known, belief by most, financial professions in the industry, especially the folks that track, the economy and mortgage rates and things like that. But, we can't guarantee that.
Right. Absolutely. So, Well, who knew in the January jobs report it was supposed to be 185,000. It was 517,000.
Yeah, 3 times more.
Yeah, that's crazy. So, you just... nothing is for certain. But you're always kind of. But the good news about the way the ARMs work now is you're kind of hedged against worst case scenarios a lot better. You're a lot better protected than you were in the past. So.
Yeah, you're forced to do that principal and interest payment. Yeah. You're steadily paying down your mortgage. So as opposed to again resorting to that negative AM option, or even just an interest only option. Yeah. But so again, I think it's a program that needs to at least, when you're speaking with someone about the process from the financial side, at least have a conversation about. Absolutely. And again, it might not fit, for everybody's, financial, picture. Mm-hmm. But that's our goal, to provide them with information, and it's their goal. We want them to then make an informed decision.
Yep, exactly. All right, man. Well, I think that's a lot of great information on the adjustable rate mortgage. Definitely an alternative to the 30-year fixed or even the 15-year fixed, but. Really good info. I definitely think that anybody who's looking to get a mortgage anytime soon should be taking advantage of the ARM and at least looking at the numbers and figuring out if it's a good fit for them.
For sure.
All right. Well, I really appreciate you being here,
Thanks a lot.
we're going to wrap it up. All right. Thanks, Jeremy.
Take care.
Appreciate it. All right. Well, thanks again to Jeremy Jordan with Atlantic Bay Mortgage for coming and talking to us a little bit about adjustable rate mortgages. If you are interested in starting the mortgage process, or you just have any financial questions whatsoever around mortgages, give Jeremy a call, shoot him a text, send him an email. We'll have all of his information in the description for you. And then if you are thinking about making a move and you're ready to get started, give me a call, shoot me a text, send me an email. I would love to help you out. In the meantime, don't forget to like this video, share it with anyone else you know. Leave us a comment if you have any questions about the adjustable rate mortgage. We can jump in there and help you out. Then, of course, subscribe to this channel to see all of our future videos. Again, my name is David Tortellini. I'm with eXp Realty. Thanks so much for watching.